again, we come back, and as you saw, for the next 30 days, even for the period that we are in right now, which is September 26th, this shows that we are moving into a bullish period for the next 30 days. But what if I increase that to next 60 days? What happens? We jump to 69 opportunities and 95% bullish. So the market has turned from historically bearish to historically bullish.
Right.
So it's time to start looking at more of a bullish trades. Unlike last week that we were looking for bearish trades, and by the way, that trade worked perfectly the following day. It was on Dexcom. Dexcom just dropped the next day, I think $7,
Wait.
20%. And if you place those trades, I know Keith did, you made, I think Keith doubled his money.
So option again. So just to stay consistent, you've shown a new view here on the table on the left. And if you were to sort by the TWR, the TradeWave ratio based on MFE, just want to, yeah, you get MOS like I did.
Yep.
And that's a 50-day hold. That's interesting. And we can see what that looks like.
Yeah, and as you can see, the Sharpe ratio is below 1, but TradeWave ratio is huge because look at the light green part. This stock tends to go up sharply, and then during this period, come down and close lower. Still profitable, but it keeps having this light green tail. That's the reason that TradeWave ratio is high. And this is perfect for bullish. Look at this, 2024, it was a loser, yet it went up 10% first. I would have been long out of this one before it closed down 0.79%.
Right, within those 50 days or so that you're looking at, yeah.
Right. It's all about the number of days that you put up here. Because if I remove that, you can also look for, if you're interested in longer term, like 120 to 250.
Oh, no.
Different list.
Sure. Sure. It's all about conforming this to your trade plan.
Exactly. So that's completely different. And as you can see, 125 opportunities are all long when I look for at least 120 days.
Sure. If you can go back to 2 and 60 again. Okay. Okay. So, and then sort by TWR. I like some of this like DPZ that you see there, only because it's a short. It's only 19 days to effectuate the return. But I don't like how I don't like all the risk there. Oh, it's a short trade too. So it's
a short trade, right? Whenever I do short trades, I am not a fan of short trades, but I do place them. Sometimes market just tells you that's the only thing there. I want to have a trading plan that gets me in and out as soon as possible, because one thing that happens more than 2/3 of the time, statistically, overall market is bullish. Less than 1/3 of the time is bearish. However, it moves much faster when it's bearish than when it's bullish. And it keeps flipping back and forth between a bear market and a bull market. So the best plan for a bearish trade is so that you're in a short-term trade, taking that into account.
Totally. You know, there's one other thing. Maybe we can turn this into a question to the group that's here and get some participation. When you see this data is so important to have, because it guides the plan that you have when you make the trade. So now you've made the trade and you're in it. And if one of these is for MOS, you're in there for 50 days and you're like, okay, I'm guilty of sometimes forgetting the reasons why I got into a trade or how I got into a trade. I'd love to hear from the group and then from you, Afshin, to wrap it up as to when you make the like, how are you, where are you documenting? Where does everyone document their reasons for trading? Because I
documented here.
You put it to the portfolio manager. Okay.
I added to the portfolio, and then
you jumped the gun there, Option. I was going to see what everyone else, if everyone else knew to do that. But
oh, sorry. Hi, Anne-Marie. Thanks for joining.
Glad to be here.
There she
is.
Dave.
How are you?
Anne-Marie. I'm great. I'm filling your seat while we're waiting for you to come out of the green room.
Warm. Awesome.
Wow, is that a new haircut? You look great.
It's Friday ponytail day.
It's ponytail. Okay, great. Very good.
Awesome. As you know, the last trade that Anne-Marie did was a smash hit, and I actually went and created a video, and I put the results at the end of it. I don't know if you saw it yourself, Anne-Marie, or not.
I did.
You did? Okay. And
go ahead, Option.
That was awesome. And today, Anne-Marie, we showed one very interesting fact for today.
I was going to say, Option, before we jump around, I wanted to make sure, because thank you, Blake, for responding. Just to finish this out, like how you use the portfolio manager to record your reasons for getting in a trade that you find from the tables and such.
Yeah, when I select either something that's on the opportunity manager, or I make adjustments to it, and then I click on plus and I add it to a portfolio that I already have selected. For example, this is the DPZ here.
Mm-hmm.
You can write notes about it that get saved in this.
Okay.
So, and I put my thoughts in there, or what I want to remember.
Right. Like.
And another thing you can do, you can also create yourself reminders.
Oh, so is that new? So it goes to your Google?
No, that's been around forever. It's so you can create a reminder, and
can you go through all that? Can you actually go through all that and put that on your calendar?
Yeah, it goes right into your Google Calendar.
Okay.
As an event.
Okay.
And you can decide what time also. So let me just show you one thing, Anne-Marie, that we went over. I went to 2-30 for S&P 500 stocks for today. And we noticed, unlike last week when things were bearish, things have turned bullish. However, only 22 opportunities were found, and 20 of them are long and 2 short. So last week was majority short opportunities.
Yeah, and I think that works really well with what we know about the last week of September being seasonally weak, statistically speaking. So I like that. I also use the sell Rosh Hashanah, buy Yom Kippur sort of thing, and that's October 2nd. But what we've seen is institutional traders flip today after a very, very big battle. So we could have ourselves the next run to the upside. Inflation numbers came in kind of light, and so they're not super worried about that. They were concerned about them being a little hot, and so they do think that that's more fuel to the fire of, hey, can we get our rate decrease again at the next Fed meeting?
Right. Just as one other thing, we showed that October 26th, which is a magic date.
Look 28 at the
bottom.
Actually, you selected 28.
27. Look at the bottom. It switches to 141 opportunities. This is up to the next 30 days. 140 of them are long, 99%. That's the most bullish time of the year.
Wow.
Start October 27th. So one thing is, look, 141 opportunities were detected, which are with high historical probabilities. But when I go to September 26th, which is today, although it's bullish, but it drops to 22 opportunities. So it is bullish, but the number of opportunities are less. And that's for the next 30 days only.
Right. Back to that October 27th, what I notice is all of these are short term, the days in trade are less than 20. I mean, a lot of them.
No, this is set to less than 30. So one of them is 28.
Yep. So a lot of them are in less than half that.
Yeah, so if we stack rank it, I see what you're saying, Dave. There's just most of them have really short-term, short cycles.
Yeah, like quick wins.
If we sort from lowest amount of days to highest amount of days, that's what Dave was talking about.
Right, but I actually sort by TWR, the TradeWave ratio, the last column
gotcha.
there. And then I say, okay, so with a high ratio of, Sharpe ratio and maximum, what is it, FE, which is
MFE.
MFE.
Which on short would be the pink part.
Right. Maximum favorable impact or effect. And then I start looking and saying, okay, what could be a 13-day quick win or an 11-day quick win?
Right. And then you can also look at the average profit there. Anyways, it's all yours, Anne-Marie.
Oh, well, all righty then.
Do you
I'll take that.
Yes,
let me share the screen. And so my thought is that most of us who trade seasonality, we really are looking for a little bit longer price action events. And so that is something that it's a sharing not turned on, sir. So I'll ask again. Yeah.
There you go.
All right, I'll try it one more time. And welcome everybody that came. Happy to have you. I was really crossing my fingers because I've had 3 meetings this morning and the internet knocked me out of all of them, and it just came back a couple of moments ago. So we got our fingers crossed. And
that was my luck.
Yes,
I'm gonna go buy a lottery after this.
Luck is a good thing.
Yeah, Keith mentioned that.
Yeah, so my thought was, let's position some things. We know we're turning into an upcycle event. We know that upcycle is probably going to get started within the next 30 days. And so my thought is, how can we position to take advantage of those things? So if we want to look first for, let's look for those long positions that might start a little bit earlier. And so something that I feel is very strong is Broadcom. And so you can see that, of course, the chart agrees, and there's a lot of upward price action. It starts a little bit sideways, but then it really begins to take off as October begins. So a couple of ways you could look at positioning yourself using options. The first is my favorite way to say, all right, we've got upside potential. How can I position early and have options leak a little bit in my favor? And so we're going to put a couple of positions on like that. We can see that our average gain is 19% between September 26th and December 31st. I'm actually going to use the December expiration date. and that's about the 16th or so. We can see it turns into that one down dip. And so if you're so inclined, you can use the expiration of January when we set the trade up so that you can get a feel, but put in your calendar, hey, listen, come December 31st, I really need to watch out because this has a tendency to give back. And now my thought about why some of these get back in December and January, when we look at a lot of companies, they pay stock dividends. Well, not dividends. What are they called? They're called, starts with an R. I can't remember. But that's how they pay their employees. And so they'll pay them in this stock as part of their bonuses, and price action will drift down because of that. And so we normally see that. I suspect that's what's going on here with Broadcom for a little bit into January, but then it gets a little bit wiggly towards the upper edge where it's got some pretty savage dips in the space. So that's a really great place to look at it. What I like to look at is the median, and I will pull that back just a bit because I can see these bars are not very uniform, right? So we've got a 38% increase for 2023, and 2018 we have only a 4%. And so I'm going to look at both of those and I'm going to go, all right, let's see if we can get somewhere in the middle. That gives us about that 14, 15%. So for me, because I'm always looking at how can I build something conservatively, I look at where my maximum events might be from a middle of the road perspective. So we're going to look at a 14% return. Let's go to thinkorswim. And let's minimize this. Let's take a look at Broadcom. And I'm going to push this. Hang on a second. It's lagging a little bit. I think it's the internet. But as we stare this down, if we're sitting here at 330, which is a very interesting zone, right? It's the close of the week that presented earnings. So a lot of traders are going to say, this looks pretty good. As long as I hold above this 330 area, I'm going to be in pretty good shape. And so as the market dipped today, it came back up, holding the zone, looks pretty good. So let's look at all the different ways we can build positions based on our general temperament. Again, you can use December options, you can use January options. So the first one is, and I'm going to take the midpoint about, I'll say, let's see what December is carrying. December's carrying $64 of implied volatility inside of it. And so that's right in the area that our seasonality from TradeWave gives us, which I think is pretty extraordinary, that it comes in right at that edge. I like that zone. You can see there's a lot of volume being tracked in here. So if it goes all the way to this edge, that'll be almost 400, right? Right at the 400 level. If you are very aggressive and you are thinking we're going to have monster bullishness, you can do something like that. My thought is, why not take us where we are and set up a $40 range that moves us up into that midpoint, and 390 we leave as the top. Now you might go, wow, that seems a little underestimated. I don't like that. I'm going to change it. So all I want to tell you is the following. You can use December, you can use January. January, a little bit cheaper, and that's because we know it's got that little bit of seasonality pullback. So as long as you don't close it after that fact, it should be perfectly fine to hold the levels. So my goal is to show you all the different ways that you can trade it. So I'm going to start over and I'm going to show you the relative butterflies if you say, hey, I'm just going to use the average numbers. I'm not going to underestimate. I'm just going to do exactly what it is that it says. So we're going to use that 15%, that's about, I don't know, 15 bucks, maybe. 10% is 33 plus another 15 is 50, right? So we're going to look at $50 from here, and that's going to be 385. We want that to be our center strike. So we don't have 385 trading, we have 390 trading. So if we want to do a butterfly, we can do 370. We want to buy the 370s. We're going to sell two of the 390s, and we're going to buy one of the 410s, right? That gives us $1.55. It says, hey, listen, it's not going to move dramatically. It's just going to come into that 390 area, and we're going to hold on. It's got $2,000 of upside for $150 of risk. So you might go, that seems a little pie in the sky, doesn't it? Well, if we're using the data from TradeWave that says, hey, listen, this one's going to have a bounce, and we use the implied volatility in here, it is very likely to give us anywhere from 2 to 5x on this particular space. If you say, hey, you might say, why is the other one so expensive? Because I bought it at the money. When you buy something at the money, your butterfly is going to get much more expensive. If you think somebody like Keith might do an Elliott wave motion to see how far it goes, maybe he's got a bigger number. Keith, you'll have to send me a note. Let me know what you think about that in terms of the broad motion. If you're thinking to yourself, wait a second, I think this is going to have much more action. I think we're going to have a monster fourth quarter. Let's get after it. You can say 380, 410, and then 430. And that's going to have $3,000 of upside for a little bit more than twice the price. So bang for the buck, that totally works. If you want to give it more time into January, you can use the strikes here as well. For someone like me that likes to do setups that involve a credit, I'm going to do a ratio spread. So I want it to get to that area, but I don't want it to go over. So I'm going to buy the 400s, but I'm going to sell two of the 420s. Now, it's going to take $4,000 of margin for me. It says that on the bottom there. But I get a $3.32 credit. Now, what's great about that? Well, what's great about that is I've got $2,000 of upside that literally, as long as I don't go past 420 by December the 19th, I'm going to collect all of the premium and I'm going to collect a credit. So the reason I like the back ratio is threefold. One, it does nothing. Price does nothing. I make money. Two, price fades. I make money. Three, price lifts, but does not get into 420. I make money. The only way I lose money is if it breaches 420, and really it has to breach 421.70 or something like that, right? So I have 3 ways to win and 1 way to lose. And so that's how I look at engaging in the market all the time. Let's say you go, I don't like that, makes me uncomfortable. Who wants to be naked a call when the market's going to the moon? Totally understand that. Here's what we can look at. The baseline support for Broadcom right now is about $288, somewhere around that. It was how the month opened, and we had 1, 2, 3, 4, 5, 6.5 weeks sitting in an inventory accumulation space. So within the market, because markets are only created to facilitate trade, what big money will do is together, through arguing, they'll find a place where they agree that price shouldn't go below it or price should go above it, and then they bring out the gloves. And those gloves are going to be the fight between the buyers and sellers, where the sellers think, hey, it's going down. The buyers think, hey, it's going up. And as soon as it breaks that ledge, distribution starts. And that distribution is upward motion. It normally sends us into another congestion zone. We call this congestion, but it is also inventory accumulation. It's sort of like walking up a set of stairs at a stadium. You'll either go down or you'll go back, but there are always 2 pirates fighting each other, one on the lower end, one on the upper end. Somebody's going to get the win. So if that support is 288, we can look at the chart and we'll go, you know what? I can sell the 280, 270 put spread. What it'll give me is $1.87. And that's a credit. Now, if I want to buy one of these call spreads, but I want to make sure that I'm not using all of my own money, I can put a put spread on. Of course, the easiest thing to do if you are a trader that's eager on getting into the position, but maybe you haven't ever done butterflies or anything like that, you can simply buy the 380, 390 call spread. It's going to cost $2.35. It's got $1,000 upside, and you get what you want. If you want to take more risk and you say, hey, I think it's going to test 400, it'll cost a little more, but you'll have $2,000 more to the upside. So you can see, really, if I spend $238 and I make $1,000 less my $238, but I move it to that 400, and it's only $2 more to do that. If you think it's going to run, it's better to take the more expensive position for yourself, because you're just going to end up making more money if you think it's go to 400. If you want to do January, the prices will change just a wee bit, right? Usually a little bit more volatility into the beginning of January. My thought is, how about putting it there? We'll see if the Santa Claus rally gets you, and you're in great shape. So what I love about the options market combined with TradeWave is the following. TradeWave tells me the likelihood of motion, but it is just a probability. So I want to position myself in the direction of that probability, but expose myself to the least amount of risk. And so that's going to involve using an option. You could easily buy the 334, and then, if you bought 100 shares of that, right? Or however many shares you want to buy, and you sold the 400s, you're going to get it at a discount, right? Almost $10. So it'll be like you bought it for $325. But if it does nothing, then all your credit space is just sitting there locked up. And that takes, a fair bit of margin. It's going to take 18,000 bucks to take that position on. So not what I would ultimately do in that space, but there's the choice for that one. Does that make sense? Anybody have any questions about that? Crickets.
No, you've been too crystal clear.
I know sometimes if you want to, my thought is options are like a mixing board, right? And so you get to move the slides. And my thought is, having traded a very long time, I love the opportunity for upside drift in my portfolio balance, but I'm always looking at the thoughts that say, what if it's not quite what I expect? Is there a way for me to still make money? And so that's why I like this one so much.
I was able to follow pretty much, Anne-Marie. Thank you for kind of sharing what's inside your mind and your process here. And right up through back ratio, I kind of understood the justification. The verticals I started to glaze a little bit, but your process is sound about accounting for different scenarios. You can twist yourself into pretzels, which I started doing when you went beyond the back ratio part. But the other aspect of it is that if I'm not a thinkorswim, I respect the platform, and as you do it, it makes clear a lot of sense as to how to put this together.
Yeah.
That those who use different platforms, it's kind of hard to say, oh, how does it look in
yeah. And luckily for me, I've been around so long that I have experience with a lot of platforms. And if you trade size, Tasty Trade is the way to go because they don't charge you to close your position. They charge you an opening event, and it's more expensive if you're just trading onesies. But if you're trading size, absolutely beautiful. Schwab, Merrill, Fidelity, all of those guys, they are trying to make it easier. And so literally most of them have drop-down menus that say, okay, I want to buy a butterfly, I want to sell a butterfly, I want to buy a spread, I want to do a back ratio. They might not call it a back ratio. They might just call it a ratio spread. And so luckily that's not as hard as it used to be, but nothing wrong with picking up the phone and calling your broker because,
that's what
they owe you that.
Yeah. Very good.
By the way, Anne-Marie, Blake has a question asking,
Please.
is the back ratio one of your favorite options?
Yes.
Strategies.
It is one of my favorite option strategies. I use it routinely. Now, does it take me to the woodshed occasionally? Yes. And if you're not from the States, being taken to the woodshed is a bad thing, just so you know. It has had times where I've had to go into triage and say, uh-oh, I better buy a spread to protect this. What do? I use an alert. I always have price alerts on any single position that I take. It's very, very important. Do I carry hard stops a lot? No, because as market volatility rises and falls, things can get a little weird there. But if I don't have a hard stop, it's probably because I own the stock at a much cheaper price.
Yeah, I mean, I learned your style of back ratio, which I was not aware of. It's very interesting the way you do it. I've always done it differently. I actually did one and sent it to a friend of mine who was convinced Nvidia was going to crash this week. So I did it different. He wanted to be able to make a lot of money, but not risk. And the back ratio that I give him, when you buy
two and sell one.
You buy two, you sell one. Exactly.
Yes.
And that's
yes.
when you can, like, that's what you wanted to have put.
Yeah, exactly.
When Enron crashed, that's what you wanted.
Yeah,
To
absolutely.
stratosphere, those.
Yeah. Here's the great thing. Options are so flexible that as long as you put the right framework around what you're doing, and that framework comes from TradeWave, that framework is the anchor for why we're able to put the positions on. If we just go willy-nilly because we go, oh, it looks like it's going to do X, Y, or Z, we don't really have a statistical approach to what we're doing. And at the end of the day, the statistical approach is all we have to lean on as traders. We have to lean on the data because everything else is an opinion.
Exactly. What instead we play stats. I mean, it may not work, but it's going to work more often than not.
Exactly. So, the thing about me putting on different sorts of positions is really, how can I make it an event for someone who does not want a lot of risk, but is willing to expose themselves to, say, a $400 risk event and have potential $1,500 upside? Listen, that's great. If you're playing it to have revenue generation, which is how I use my portfolio at this stage of my career, I'm not speculating so much, although TradeWave gives me tremendous opportunities to do more of that. What I sit in the space of is, how can I collect revenue here and not worry about it? And, TradeWave gives me a chance to see, all right, you can sell a put spread here with a high measure of reliability. I mean, right now, this Broadcom short put spread has a 3% probability of going in the money. 3%. So 96.5% of the time, that's going to be out of the money. I'm going to get a full credit. I like that. I like those odds.
Well,
they mean something to
odds
me.
you're looking at, it's based on options alone. You have
Exactly.
a vehicle which actually tilts the odds in your favor.
Exactly.
Even higher than that.
Exactly.
By the way, to this day, one of my favorite trades, thanks to you, was that CF trade that I did.
Oh, I know, right?
I did a CF trade that went against me, and it was on TradeWave, but CF had other ideas like dropping sharply, and I ended up making $5 instead of losing, and it went way against me. It was awesome. This idea of taking credit for
I know
trades is just awesome. When it goes completely against you, which happens.
Yes, it does, because
don't make money.
Exactly. And we really have to be prepared to say, okay, anything can happen. How can I position myself so that I'm going to be on the right side of the curve most of the time? So now we're looking for, hey, I want to win every time. It's an expected return, right? And our expected return over time is what we're after. And so, that's why TradeWave has become just one of my most favorite things. It literally is one of the first things I fire up in the morning to have a look at.
That's awesome. makes me really happy that that's the case. But options is, I've studied options so much. I've even learned to derive Black-Scholes formula. So I understand the math of it really well. Options are a three-dimensional strategy for
Yes.
that, like a stock. If the price goes up $1, you make $1. Option
Yep.
has three things: the
Yep.
price, the time, and volatility. And actually,
Exactly.
also interest rates.
Yes.
I've actually seen the interest rate change immediately affect the option price.
Yes.
So I guess it's a four-dimensional strategy.
I was just about to say it's probably got a fair bit of dimension to it, especially if you're a trader that is very accomplished and you might want to do a gamma spread or all those sorts of things. I have to tell you, I am a caveman options trader. And what that means is I look at delta and I look at the probability of expiring in the money. And those two things are the things that I begin to focus on once TradeView gives me my idea for what the trade should be. And that is literally it. I just refuse to clutter my mind with too many things. I truly do. I've learned that less is more.
Do you look at implied volatility too?
I look at implied volatility all the time because the higher the implied volatility is, the higher the credit you'll get for putting on a position.
Right. And if you do it wrong, if implied volatility is high and you go into the wrong trade,
oh yes,
when the
it's going
implied
to shred
volatility
you.
drops,
Yep,
then you could lose
exactly.
money when the stock is not moving.
Exactly.
Or
Which
even
is
moving
why
in your direction, and you still lose money.
yes, which is exactly why I love to sell these. I love to sell volatility. It's my favorite thing to do. And what I'll do, because selling volatility can be dangerous, the implied volatility spiked for a reason. It spiked for a reason, but if you use something like TradeWave to build your structure out and you go, okay, let me see what the vol is. So TradeWave might give us a setup that says, hey, this is a long setup for XYZ and it's going to give you that. And I go and I look at the implied volatility and it's under 23%. I won't take the trade because it doesn't fit in my wheelhouse. It doesn't mean that that's not a winning trade, but for me, using option chains, I'm going to go where, the juice is going to be worth the squeeze. And instead of just making that 14.5% that you might make if you just hold a stock, we are looking at 300 to 700%, right? In terms of gross return.
Right. And you need one of those for every 5 that you lose.
Exactly.
Which is not going to happen either if you do your homework.
Exactly. 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 And you put alerts on your price action event. That's super important. You've got to be vigilant to watch price actions. And so here's the last thing I'll say about that. Let's say that this thing starts running off the rails, and in November, this moves to 400. Let's say the price of Broadcom moves to 400. Now you'll be sitting in a formation that is going to be in good shape, but it's going to be a place, even though it's November, which is a month earlier than the expiration, if it starts creeping over this middle strike, it's better to close it and take whatever the market gives you. If it's 2x, 3x, if you were looking for 7x, just, open the trash and throw that wish in there. It's not going to happen unless the market rotates downward, and Broadcom does not have that type of price action in general. So you take your money and you run. And that's really, really important. The closer you get to expiration being over the middle strike, the more your butterfly will leak on you. And the closer you get to expiration, now theta decay doesn't really matter. The only thing that begins to matter is price, and this will erode. But by the same token, my thought is this: set an alert for the middle strike and then set a maximum loss of 50%. If your option position, if your butterfly gets lower than $75, sell it. Take the 75-cent haircut. That's a lot better than taking a $30 a share haircut or whatever, right? It just makes more sense.
Yes, that absolutely makes sense. And Greg is asking if there's going to be a recording of this. And yes, Greg, I'll have a recording of it by weekend.
Yeah, hopefully, when Broadcom, I suspect Broadcom will turn around next week. What I would say is let the charts wiggle out. Today, there was a tremendous institutional fight inside of the futures. I haven't seen motion like that in a very, very long time. Just a savage run, thousands of futures contracts to the upside, thousands of them to the downside in sort of a V. And that means they're fighting. And so we'll see who comes out on the top into the end of September. But, maybe Monday or Tuesday is the day where you go, I think I'll take this one today. So if you say, hey, I want to try it right now, I mean, the market's lifting. The buyers have tried to put a floor in and it seems to be holding. And so not a bad idea, especially on a day that Broadcom is down just a little bit. You're getting these on the cheap. So there you have it.
Awesome. Yeah, these are just great trade ideas. Fantastic.
Yeah, we'll get more of them together. We'll put them up together. It's fun. I love talking about the markets, of course. And so I love seeing the mechanical flows of things. And when we have something as strong as Broadcom, there's a comfort factor there because you can see, hey, listen, this has been holding pretty steady. Let's give it a go. Let's give it a shot.
Right. Yeah, I mean, Broadcom is one of the ones I've traded many times and always successfully. Luckily, I've always made money on Broadcom.
Yeah, it's a good one. You don't want to short it, at least for long. You don't want to short it for long.
Right. Oh, Broadcom, I don't think I would dare short it.
Yeah, it'd be rough. Yeah.
But I do have, it's way early. I can show how NVIDIA is actually a good short beginning of next year.
I'd buy that.
And believe it or not, NVIDIA is one of the most interesting stocks. They just hit to become the single most valuable company in the world. They are $4.4 trillion. But if you look at their revenue, 70% of their revenue comes from 5 customers.
Yeah.
5. And those are obvious who those 5 customers are, which are Facebook and OpenAI and a few of those. But think about this. Right now, the entire market is driven with NVIDIA. So if NVIDIA goes down, everybody's going to follow. And NVIDIA is going to go down if one of those 5 customers stop buying or reduce their purchase.
Yeah. Yeah.
It's a very
dangerous. Next year, as we know, next year is going to be pretty interesting.
very interesting. The first 6 months, I mean, the whole idea of the 100-year pattern, which is the name of the book, is that from beginning of the year until September 27th, market is the weakest it is in a 4-year cycle. It goes down. It has gone down pretty substantially. And then it turns around on September 27th for the next 295 days. It's the most bullish time.
I know, I'm excited. I'm excited. We're going to have all the members super prepped for that. We're going to make sure they're all tracking.
I keep mentioning that. I keep mentioning that. TradeWave also shows as Schwab high probability. I'm already in this trade. Oh, Blake is saying that he's in a, I think that's a Schwab trade. I did not see it.
All right, let's have a peek.
Oh,
I haven't traded.
Looks like you've traded that too.
Yeah, last time I traded it was in February. So let's have a peek at Schwab. Interesting. 2018. Of course, I think this was what wasn't it that bank?
Yeah, there
in the
was
West Coast.
There was some
it was
issue
something
with
like that.
bank, and the entire market dropped. I think it was in December or
something
around that time. It was when I look at TradeWave, that was an anomaly. It was not normal. As I always say, TradeWave shows you the seasonal winds. It doesn't talk about hurricanes.
Yeah, exactly. Yeah, this looks pretty good.
Oh, that is
This looks
sharp.
pretty good.
Yeah.
Yeah. Thanks for the heads up. She writes the note. Yeah, it looks pretty good.
Yeah, that does look very
Yeah, it looks
sharp.
pretty good.
Oh,
Yeah.
that's a good discovery, Blake.
Very nice. Very nice. Well, if that's it for me, then
Well, thank you so much. Yeah,
it's always my pleasure.
It was very awesome that you joined, and please join whenever you have the time. It would be
I will do it. I will do it.
It would be awesome.
All right. Thank you.
Well, thanks,
everybody.
everyone. Thank you, Anne-Marie, and have a great weekend.
You as well.
Bye-bye.